Welcome very much to this session on our new working paper called The Green Banking Gap: How Bankability, Business Model and Regulations Challenges Banks' Decarbonization. My name is Paula Haufe. I'm part of the research project SUFI Climate Change and Global Finance at a Crossroad at Witten University. We are a large group of researchers. We are 7 people. Most of us are also in the room. Professor Joscha Wohlweber, Janina Urban, Jan Fichtner, Ricardo Baioni, Simon Scheirer, and of course, Nicolas Aguilar, who is the lead author of this paper that we are discussing today. And we are also very happy to have the strategic manager of the Trace with us, who has also been helping and doing the organizing for this event. Sonja, please.
Yeah, welcome from my side as well to everybody. I'm really happy to welcome you to this working paper launch, which is already the second edition of our working paper. But first to the Trace, I'm strategic manager of the Trace. Trace is short for International Center for Sustainable and Just Transformation. And we are a center at the University of Witten with the aim of bringing together and fostering sustainability-oriented research. In general, we operate on 3 pillars, which is research, of course, but also teaching and impact. And that is also why we have launched this working paper series. It is to better combine and promote precisely these 3 pillars. The working paper presents current scientific contributions from our research. So it goes into ongoing projects as today, theoretical concepts, empirical analysis, and so on. So our aim with the working paper is to open up the scientific discourse at a very early stage to encourage discussion and also provide tools for politics, civil society, and science. Because the sooner the trace research gets out into the world, the better we can actually stimulate discussions in research and teaching, and by this also achieve an external impact. Yes, as I said, today we are already very proud to present the second working paper in our series. We will talk about the green banking gap, which is basically the persistent gap between banks' climate commitments and their actual lending practices. I'm sure Nico will say a lot more about that. And for further upcoming papers, have a look at our website or subscribe to our newsletter to stay tuned on our events and papers. Yeah, that's from my side. Thank you.
Thank you very much, Sonja. And then before we start the presentation, have the pleasure to also welcome fabulous guests we have with us today. We're really happy to welcome Mareike Beck, who is an assistant professor in international political economy at the University of Warwick. She was previously at King's College London and holds a PhD from the University of Sussex. She has ample knowledge on banking and banks as institutions and has looked in particular at how US finance has shaped European banking, something that you, Mareike, have coined as extroverted financialization. And she also does really, really cool things such as being an aerial acrobatic. And 2 years ago, she has done an exploration of feminist political economy perspectives on homes as living space and financial assets using the circus as a means of research and exploration and communication. It's really nice. I actually saw the video. It's really cool. Christoph Scherer is also with us, our second guest and commentator today. He's an emeritus professor at the University of Kassel for globalization and politics. He has previously been to Freie University Berlin, Rutgers University, and Harvard. He's the founder and director of the International Center for Development and Decent Work in Kassel. With its 2 study programs on global political economy and labor policies and globalization. And he also has a strong connection to the research field we are looking at today. He has finished vocational training as a banker before he studied. And especially since the financial crisis. He has a renewed interest in the role of banks and specifically public banks in an age of financialization and how we can use them or how they can be put at the service of public goods. And with all of these words, we're really looking forward to your comments. We are happy that you're here, and I hand over to Nico for the presentation.
Maybe very shortly. I'm sorry that I'm late. I had computer problems, but now I'm here and I'm very happy. Welcome you from because I'm a team lead of a bigger research project where this paper is part of, and this is. I just want to say this is a fantastic research group, and we're doing really great stuff. And this is only possible because of these fantastic people in the group and my team. So very much looking forward to this presentation. Thank you. Floor is yours, Nicolas.
Great. Thanks a lot, everyone, for being here, but especially to Christoph and Marike for being so kind to agree to discuss our paper. It is also a pleasure for me to be presenting the second working paper of the TRACE. And what we do in this working paper is to look at commercial banks and what they have been doing when it comes to the green transition. And let me just start by saying that what we found is a bit disappointing because banks have been rather slow to decarbonize their portfolios, both because they have been slow to increase green lending, but also because they continue lending a lot to high carbon emitting activities. And just to give you a taste of what the situation looks like, according to the World Bank, the share of green loans in advanced economies, green loans are those that are tied to specific use of proceeds, is around 0.2% of GDP in advanced economies. In 2023, it was at least, which is very, very slow, very small. But if you look at sustainability-linked loans, which are those that are contingent on improving on certain key performance indicators, are only slightly better. If you look at the combined share of both of them, it's around 0.5% of GDP, which is, again, nothing. And what's also worrying is that the trend has been declining since 2021, as you can see in the chart. And also very worrying is that if you compare the situation with emerging and developing economies, the shares are even smaller. In Europe, which is kind of the focus of our paper, the situation looks also quite grim. The green asset ratio, which is the share of taxonomy-aligned assets over total assets of a bank. This is a metric that has been quite criticized for good reasons, for instance, excluding SMEs and so on. But still, that the number is only 2.5% of GDP, according to a number that the EBA released last month, speaks of how dire the situation currently looks like. It's really 2.5% of a bank's portfolio is really nothing. And because of this, 90% of banks in Europe face high transition risks, according to the ECB, and 70% of them are subject to reputational and litigation risks because they made commitments that they are not fulfilling. And so based on this kind of green picture, what we ask in this paper is why are banks in this situation? And to answer this question, we ran 88 interviews, 21 of which were with bank employees, but also the rest of them were with people quite familiar with topics on finance and sustainability, working on shadow banks or the public sector or CSOs. And what we found are that the answers that they gave us can be kind of grouped into three categories. One of them is bankability. And this basically means that green firms and projects do not currently meet banks' desired risk return profiles, while dirty activities still do. The second category pertains to the business model, which speaks to limits to decarbonization due to two things. One is the change in banks' business practices, and the other basically because they have shied away or moved away from corporate and project lending towards market-based activities, among others. But even when banks still lend, there are some constraints to decarbonization that arise from the character of lending. And finally, the third category is regulations. And here there are different things involved, including financial regulation, but also the recent sustainability regulations implemented at the EU level, which according to our interviewees, both of them limit green lending for different reasons. But also they mentioned certain policy uncertainty about the future decarbonization path of the economy that doesn't really incentivize firms to invest green or to divest from their activities. So what I'm going to do now is to walk you through each of these three categories and explain them into a bit more detail. So let me start with bankability. So bankability basically means that green firms and projects do not meet bankers' expected risk return profile. And there are several reasons for this. So one of them, quite straightforward, is that there are very few profitable projects. So according to Finance Watch, only 30% of mitigation projects are currently profitable, while only 20% of adaptation projects are currently profitable, which is, a very, very small number. But also, many of them, even when they are profitable, they have a lot of risks, partly because they are small scale or local, so they do not meet minimum investment values. Also because green technologies are young and not really mature, but even when the technologies are already more or less established, as is the case of renewable energy, for example, many banks say that the firms are new, so they have a lot of counterparty risk. Even though the technology is sound. Also, there is a sort of mismatch in the investment horizons between banks and green investments. So banks' investment horizons are typically 5 to 7 years, whereas those of green investments are longer, so between 15 to 25 years. So there is a mismatch there. And finally, one additional point is that clients also do not know how to originate green projects quite often. So according to one interviewee, the conclusion is you have something like quite low profitability, high risk, uncertainty. It's really a lot of issues. Something quite interesting from our perspective is what is the conclusion that our interviewees draw from this, which is that there is the problem is not a lack of money, but a lack of profitable projects, right? As one anonymous interviewee told us, I don't actually think we have a lack of funding out there. I think we have a lack of bankable, robust projects out there. And along very similar lines, another said, there is so much ready to invest money that likes to go into these green applications. What is missing are viable business models. And so this speaks to certain structural limits of the private sector. And this is particularly interesting for us because in the EU, at least, a lot of the bets to solve the green financing gap have been to try to escort private funding towards green projects. But what these people are saying is, well, the money is there. The money is not the issue. The issue is mostly on the real side of things. And so, kind of a sort of summary of the situation, another interviewee told us, most of the financial industry infrastructure is built around risk and return. And I think that it is really hard to insert net zero or climate impact into like this bilateral framework. And something also interesting is that these kind of structural pressures that banks face between profitability and risks also impact how they can support public efforts. And here one interviewee shared their frustration with how public actors were appealing to banks, kind of expecting free loans. So let me just read you the quote. One interviewee told us, for public players, we are getting a bit desperate because local authorities in particular expect free loans and will never give them. So again, kind of from the policy side of things, sometimes there has been a lack of understanding of how banks work and how they actually operate, which has been a hindrance to decarbonization efforts. But in contrast to green activities, what we found is that dirty activities remain highly profitable. So just to read a quote, some of these carbon intensive exposures are very profitable. So the banks are extremely reluctant to get rid of those. Also, they have very low risks because climate and environmental risks are not really priced in. And this will be the subject of a future working paper, so stay tuned. One interviewee told us, if you're a bank that is lending money to gas and oil, where those prices have been post-Russia-Ukraine, your credit risk looks great. And this is all something that came up a lot, even with in our interviews with bank regulators. They were saying, well, if I, from a microprudential point of view, compare the credit risk of a dirty activity vis-a-vis a green activity, what I see consistently is that the the green activity looks worse in terms of risk than the dirty activities. So if these activities are highly profitable and low risk, then banks keep lending to them. So one interview put it quite bluntly, this is a profitable line of business. It's going to make you money. You should keep doing it. And indeed, they keep doing it. So if you see the financing of fossil fuels, for example, the numbers have been slightly declining overall in the last couple of years, but they are still substantial. And if you look at some specific financial institutions, they are even increasing their lending to fossil fuels on to other high carbon emitting activities. So this takes us to our second category, which is business model. And here this entails two parts. The first one is that banks have changed. And here this has been something very surprising to find. And thus Mareke's work has been really illuminating for us, trying to help us make sense of what's going on. And it's that banks have moved away from corporate and project lending. So one interviewee told us this very clearly. There is a perception that banks are sort of lending. And that's actually a tiny part, relatively speaking. But lending is typically a tiny piece, and it's mostly undrawn. So if they moved away from corporate and project lending, what they moved towards is to household lending, market-based activities, and the provision of financial services. And what this means for us is that they are trying to avoid using their own balance sheets. As one interviewee told us, our activity is connecting. Typically in the capital markets, we facilitate. We are not the lender. It's not our money. We are in the middle of that flow. And similarly, another said, well, we can support you, but we can't support you over the entire term because there are instruments that we can't offer because we can't or don't want to provide our own balance sheets. And basically, it's now almost a matchmaking process. So again, there are limits to green lending, which arise to certain characteristics of banks' business model, which they have tried to move away from lending as a whole. So maybe expecting them to increase green lending runs against the reality of what their business model looks like. But still, especially in Europe, banks lend a lot. And here there are also certain constraints that our interviewees reported that arise from the character of lending itself. One of them has to do with the fact that balance sheets are locked into all loans. As one interviewee told us, for banks, the balance sheet is some kind of inertia. It's about 10 to 15% of the balance sheet that changes every year, so it takes time to change that. But also, more importantly, banks really prioritize long-term relationship with customers, and typically this means with the high carbon emitting customers that they have had for, in one case, as one interview told us, 150 years. So banks do not want to divest from these clients that they have had for a long time, but rather they want to engage. As one interview told us, for instance, I have 2 years to get this client to improve, so I'm going to engage them now and say, okay, in 2 years, if you haven't done this, then I can't offer you a normal revolving credit facility. But this strategy has oftentimes not been fully successful, so they had to bring out the sticks as well. One interview told us that they had to be more explicit about the escalation tools that they will use to force clients to actually divest. But the truth of the matter, and this connects to the point of bankability before, is that high carbon emitting clients are still very profitable. This is a very profitable business for banks, and so they do not want to get rid of this business because someone else will take it. Instead, what they want to do is to keep these customers, but trying to influence them to become a bit greener so they can hold on to them. And finally, our third category, which is regulations, has 3 parts. The first one is financial regulation, and here it's quite well known that capital and liquidity requirements are based against green assets because they are based against long-term and illiquid assets, which are typically the characteristics of green assets. And so one interviewee told us, when it comes to Basel, I think there is a real concern that this is going to limit investments, especially in green activities. And another one told us the regulation of banks is so bureaucratic and to some extent box ticking. When I talk to the supervisory authority, it's all about the small stuff, but not about the big strategic issues. And the banks are currently being regulated to death, which is causing the shadow banking system to grow. And indeed, this is the case. And in fact, in our first TRACE working paper, we actually discussed how the shadow banking system is currently financing high carbon emitting activities. So if you're interested in that, I definitely recommend taking a look at our first working paper. The second dimension of regulations pertains to sustainability regulation. And here it's a bit more EU specific, because the EU has launched a series of regulations in the last couple of years. One of them is the taxonomy, which is arguably the best known one. And here our interviews complained a lot that the taxonomy covers only green, and it doesn't include transition activities, which according to them are more important than what they are currently doing allegedly to support the green transition. Also, they complain a lot about green labels. One reason is that they say that they are very wary of being accused of greenwashing, and so they prefer not to use the label at all in order just to avoid the potentially being accused of greenwashing. But also they argue that these green labeling efforts are very costly for banks. So for instance, one interviewee told us, from a bank's perspective, if it's like a sustainability linked product, sometimes we are even losing money on it if we just offer the normal product line, because we are offering an incentive or a discount to get into sustainability. It requires significantly more governance internally and controls, so it costs us more to actually provide the products. But it's also more costly for the customers. They say it costs our clients more to get the product if we are going to label it, because they have to disclose significantly more information. And so if it costs more to the banks and costs more to the customers, what do they do it? Well, they don't. So this is what we have been kind of consistently finding, that they prefer not to issue a green label and just offer a normal credit facility. And so this will entail a constraint to green lending, at least that's green label lending. So they say, no, we are actually lending green, but we are not labeling as such. And something similar can be said about green bonds. So one interviewee told us that this is quite costly because you have to have your numbers audited, you have to have a framework that is made, you have to have a second party opinion, and you have a lot of human resources as well that are required. And so finally, the final aspect is policy uncertainty. So many interviewees told us that firms cannot plan ahead if they do not have clear political assurances about what will be the future decarbonization path of the economy. If they know so, they can plan accordingly, but if they don't, they cannot. And this is also important for banks. As one interviewee told us, banks need to know at what pace this is going to happen to make sure the companies repay them. Investors need to know that as well, to have the confidence that they will get a good return on their investments. And one very interesting conclusion from this, that one interviewee told us quite bluntly, is don't let my colleagues hear that I said we need more state intervention, but we do need more state intervention. And this is what we need to have, because allowing the private sector, in the absence of any incentives to sort it out between them, because they want to do the right thing, is just never going to happen. And so let me conclude. So the first conclusion that we draw by looking at the issue of bankability is that there are certain structural pressures in capitalism to the decarbonization of the financial system. And here, what we think is that policies have been somewhat misguided, because they have focused too much on finance, as if that was the problem, as if it was a problem just of a lack of money, without looking at the productive side of things, without looking at the unprofitability and high risks of green firms and projects. And of course, financing is a crucial component of the green transition. We are finance scholars, we will never say otherwise. But a one-sided financial approach, of course, has limits. So what we kind of need is a policy framework that can combine both credit and industrial policy for a green structural transformation. Then at the institutional level, we really need to have an accurate understanding of banking practices. So oftentimes, policies are based on depictions of banking that are at least outdated when they are not wholly misguided. But we really need to understand what banks actually do in order to decarbonize them. And finally, at the policy level, we think that our findings also support calls for changes in banking regulation, but more broadly to the use of credit guidance tools as a form to increase the bankability of green activities, but also to provide direct lending in the cases where this cannot happen or will not happen. So I'm very much looking forward to the discussions and then to the oral discussion. So thanks.
Thank you, Nico. And I would right away invite Mareike back to provide her comments.
Hi, everyone. Yeah, thank you so much. I really enjoyed this paper and I was very happy to be invited. So thank you very much. How much I liked it is kind of proven by the fact that I'm here in the first place because we have a bank holiday today in the UK. And I struggle to be at work at 10 a.m. on a normal day. So I do really enjoy that. And obviously, as someone who looks into banks' business models, this really speaks to my heart. And I mainly have comments around tell me more. This is kind of the general sort of gist of what I'm going to say. And you've already guided us through all the main comments, so I skip what I take to be the main argument, which is roughly what we've just heard. And I really enjoyed some of the comments that you dug out. There's some really nice data, some shocking kind of lending of what they don't do or what they do instead in terms of dirty investment. But also the fact that they actually say we need more regulation. We have enough money. The problem really isn't finance. But then, I mean, you mentioned the puzzle of scholars don't really look at banks, right? Particularly in Europe, this is puzzling because these are huge. They have huge business, huge balance sheets. We know that, they're still central. So I was wondering, from your research, why do you think that it is that people don't look at banks? Yeah, so that is surprising, but are there conceptual limitations in the kind of green finance literature? Is it that banks themselves are flying really low because they know they're not doing what they're supposed to do, therefore no one kind of takes notice? What is it that, in Europe, when we all know these are key agents of capitalism, why is it that no one really looks into that, even though we know they have a lot of financing power? The second set of comment is it's a bit more of a comment of, is there a possibility to tighten the links between business model, bankability, and regulation? So I really like the clarity that you provide through these three kind of levels that highlight, well, this is a huge problem at every level, and there are obviously differences. But if we talk about business models, then they interact quite closely with both of the other levels. So bankability is a key component. It's also dependent variable, if you want, of the business model, because depending on, and you mentioned this, depending on where you get your funding from, you need certain kinds of assets that then make it profitable or not. And I think if we find out a bit more why it is that certain kinds of business model make something more risky or less risky, then maybe we can dig deeper of why banks don't invest or do. Because in a way, it's not risk per se, right? We know that these institutions invest into all sorts of risky stuff, and they found all sorts of different ways to, for example, get junk bonds out of their business model, out of their balance sheets. I just don't quite buy that, a lot of green investment is more risky than junk bonds. And, we have a growing CLO bubble that is just, there's just a huge risk that is building up within the banking system, within the links of the shadow banking, that it would be, I think, interesting to find out what is it specifically within the business model, within the green investment that, is causing this gap. And I wonder if there's scope here to bring in, for example, work by Caroline Sissoko, who is kind of making the argument that we've actually moved away from a finance system where individual agents actually do take risk, right? Or there's other literature that kind of shows how much the public basically backstops all of the a lot of finance already. So these, in certain respects, how much is this a structural constraint, or how much is this a whining of certain agents that just kind of want to have more money and don't even take that little bit of the last risk that we have. And similar with regulation. I mean, I love the quote that you brought that, we need more regulation, but a simple comparison, and this is too simplistic perhaps, but the US has to an extent more regulation than in Europe, but a lot of US banks are more profitable than European banks. So again, it's not regulation per se, but it's the kind of links with the business model that are doing these things. And you debunked quite a lot of really interesting facts. For example, the investment horizon showing, well, within 5 years, most of these loans are maturing anyway, so it cannot be, it's too slow. So can you debunk more of what they're saying and claiming? And then relatedly, and this is sort of my last set of comments, I'm wondering if you can reflect on the methodology of using elite interviews. I mean, I think it's absolutely crucial for political economy that we try to understand things from the perspective of these big, powerful agents. And I think that that's what you're doing, and I love that from the paper. But I wonder if sometimes we're taking them too much at face value, right? That's kind of related to the other set of comments. And I wonder how we kind of, do you have any thoughts or reflections how we navigate that tension? I'm curious. I faced that tension. Scott James and I are looking into the pension crisis 2022, and we're talking to the regulators. It's the same kind of problem. No one takes blame. No one tells you, oh, we're really bad, or we just want money. And to an extent, also there's a sort of, at points in the paper, they say, oh, we're just the intermediaries, right? And that's a popular myth that these banks are simply intermediaries. So yeah, any reflections on that would be much appreciated. And I think then kind of what follows politically. You've already said that in the conclusion, but maybe a bit more, because if we follow what they say, do we make the green transition more profitable? Well, then we run into the problem of kind of socializing the costs and privatizing the profits. But again, this is really a terrific paper, and I look forward to more of your work, and I really enjoy the focus that you've brought here, and the kind of conceptual clarity and empirical depth that's coming out. So thank you very much.
Thank you, Mareike. Really valuable comments. Before I give it back to Nico to respond, and also before I ask the audience to also raise questions in case you have any, you can already, write them down for yourself if you want to. I invite Christoph to also provide his comments.
Well, I'm also very much impressed by the presentation and the working paper. And I do see that the 3 categories make a lot of sense. I have 3 points, perhaps, or 3.5. They come together a little bit. The first one would be the theory. Is it not possible to have a bit of an overarching theoretical perspective on that issue, especially driven by the profitability that is necessary for banking, capitalist competition, driving that, and intervening then is the specifics of the business model or the specifics of regulation. The other point is concerning the interviews and what you made out of it. I thought that would be helpful if you would also differentiate a little bit between your findings when you talk to private banks and when you talk to state public banks. municipal banks in Germany or whatever, and especially development banks. The German KfW is heavily involved in financing the green transition. And I'm not really so familiar with the European Investment Bank, but I believe they are also into that, at least at face value. And then, of course, it would also be of interest to differentiate a little bit among the sites. Are these banks residing basically in continental Europe or in the UK or in the USA? So I think you can draw more out of your interviews by differentiation. That. Then the third point is there are some banks who are doing the lending and the green lending. And it would be of interest to find out why they think it is possible to do the green lending. And then you might have a little bit of a base to what Mareike has already pointed out, not to take everything at face value, what these bankers are telling you. And this actually leads to my 3.5 point, and that's the issue of to what extent is there actually a specific banking habitus that they are not really so convinced of climate change and convinced of social issues. That's not really what they're talking about. They are talking about racing cars and women and things like that in banking. But I would be very surprised if there would be a lot of talk about the climate change and how it really is so bad and that one actually has to do something about it. So it would be a little bit looking at the disposition of these bankers towards the world, and what kind of training do they have? Usually they have a training that is very in a channel or in a tunnel, maximizing a certain efficiency, their mathematical model or their customer relations and so on. But not so much social and environmental concerns. Yeah, but I think it's you have a wonderful base, and already the findings are very plausible. Thanks.
Thank you so much, Christoph and Mareike. I stopped the recording now.